Hi children, good morning. Today we will deal with the accounting equation when the goods are purchased on credit and sold on credits. Okay. So what our accounting equation says that asset is equal to capital plus liability. A debit is always equal to credit. Okay, now let's see our first transaction. What is our first transaction? Started business with cash. When business is started with cash, always two account is affected. One is cash and another is capital. So we'll add 25,000 in cash and 25,000 in capital. Next is purchase goods from Sham. Now we have to see what are the two accounts affected. Here we are purchasing the goods. That means stock is coming in. So we'll add the stock. Here, since we are not making the payment, we have to make the payment. That means we are having a liability of 10,000 named creditors. So when the goods are purchased on creditor, two account affected. One will be stock and another will be credited, and we will add in both. Now let's see the new equation. So we are having cash of 25,000, stock of 10,000, capital of 25,000 and creditors of 10,000. Our next transaction is sold goods to Sohan costing rupees 800 for rupees 1,500. So what will be the effect? We are selling the goods, means from stock it will be reduced here at what? Rupees 1,500. Here since we are not receiving, we will receive in future. That means we are having a debtor of rupees 1,500. So we'll reduce it from stock. We will add to debtors. Now we have to see whether it is profit or loss. It is a loss, that means loss will be reduced from the capital. So when goods are sold, we will reduce it from the stock. We will add to the debtor, and if it is a loss, we will reduce from the capital. So our accounting equation will be cash 25,000. Stock we are having 8,200. We are having a debtor of 1,500 and capital 24,700 and stock rupees, sorry, creditors rupees 10,000. Okay. Now next is withdrew from business for personal use. That means drawings. Whenever there is drawing, we will reduce it from cash and capital, because drawings reduces both cash and capital. Okay, so from 25,000, 5,000 is reduced. That means we are having a cash of 20,000 now. Next, there is no change in the stock, and next there is no change in the debtors. And capital also we had reduced 5,000. So now our capital is 19,700 and creditors we are having 10,000. Okay. So our total of liabilities side is 29,700, and if you'll see our asset side also we are having 29,700. So in this way, you have to prepare the accounting equation when the goods are sold and purchased on credit. Now let's see the balance sheet here. Whatever we were having in the asset side, that will be recorded in the asset, and we were having an asset of cash 20,000, stock 8,200 and debtors 1,500, and we'll do the total 29,700, and liabilities will be transferred to the liability side. Capital 19,700 and creditors 10,000. 29,700. So how we'll prepare the balance sheet? The format of balance sheet is liabilities, amount, assets, amount. Okay. From the accounting equation, you will transfer all the asset to the asset side, and you will transfer all the liability to the liabilities side. Okay. In this way, you have to prepare the balance sheet. Now let's see the accounting equation when income is received, or income is received in advance, or there is an accrued income. Okay. Now let's see the transaction here. So first transaction is our started business with cash. Okay. You know, when business is started with cash, two accounts are affected. One is cash and other is capital. We are having a cash of 60,000 added in cash, and capital also 60,000. Next is rent received. Rent received means we are receiving in cash. So what will be the effect? We'll add that to the cash and add that to the capital, because income is raising the capital. Okay. So here when we are receiving the income, what will be the effect? It will be added to cash and it will be added to the capital, because your profit will increase. So what is our new equation? 62,000 we are having cash and 62,000 we are having capital. Next transaction, accrued interest. Accrued interest, what will be the effect of accrued interest? It will add it to the capital because your income is increasing, and since you are not received in cash, you are going to receive in future, you are having an asset, and that will be named as accrued interest. Accrued interest is our asset. So when there is accrued income, we will add that to the capital and we'll show that in the asset side also. Okay. And what is our new equation? 62,000 plus 500 and is equal to 62,500 capital. The next transaction, commission received in advance. Income when we are receiving in advance, what will be the effect? We will add that to the cash, and next is that will show it as advance income in the liability side because income received in advance is always liability. So what will be the effect of advance income? We will add in the cash and add in the liability side. Next is withdrawn from business. That means drawings. Drawings always reduces the capital as well as cash. So it will be deducted from the cash and deducted from the capital. So, okay. So here what is our accounting equations? Here we are having a cash of 58,000 and accrued interest 500. Then capital is of 57,500 and 1,000 we are having a advance income. Okay. So that is advance commission. So what will be our total here? Here we are is 58,500. Here also we are having 58,000. Next is we have to prepare the balance sheet. How will we prepare the balance sheet? All the asset, that is cash and accrued interest, will be recorded in the asset side. Capital and advance income will be recorded in the liability side. So in this way you have to prepare the accounting equation when you are given the income, that is accrued income or income received in advance. So here is a balance sheet here. We'll see that here liabilities capital 57,500, accrued in commission that is 1,000, total 58,500, and we are having a cash 58,000 and accrued interest 500, 58,500. So here our asset and liabilities both are equal. Okay. So in this way you have to prepare the balance sheet. So let's summarize the question here. First is that when we are purchasing the goods on credit, it will be added to the stock and added to creditors. Okay. And if we are selling the goods on credit, it will be deducted from stock, added to debtor, and if it is profit, it will be added to capital, and loss, it will be deducted from capital. Next is accrued income. Accrued income will be added to the capital and added in the asset side, showed as accrued income in asset side. Then advance income. Advance income will be added to cash and it will be added in the liability side. If you are receiving the income, it will be added in cash and added in capital. Okay. If you are making the expenditure, payment of expenditure, reduced from cash and reduced from capital. Okay. So this was the summary of the problem which we solved. Thank you.